David Morgan is author of The Silver Investor that you go to www.silver-investor.com, home of the Morgan Report, also author of The Silver Manifesto. David joins me on the line now. David, appreciate you taking the time with us, and I want to start with the big question is, we have seen the geopolitical risk rise, whether it's ISIS, other issues in the Middle East, whether it's Ukraine, whether it's South China Sea. We've seen central banks in Japan, in Europe, in the U.S. all have massive money creation programs underway. Normally, we'd be told that that's what would propel silver and gold higher. That hasn't been the case. Why not?
Great question, Michael. And just to restate it slightly, I mean, you couldn't have said it better. There's nothing more going on in the world that wouldn't support the strongest fundamentals for investing in precious metals, and they're not going up. Why? Because there is enough of a paradigm between the paper market and the physical market. But as the transhumanists like to say, we're reaching the point of singularity. And what that means is that there's enough paper shuffling out there to satisfy the market today, but that may not be the case tomorrow. We have a lot of evidence of that, especially on the gold side, and we'll talk about the silver side. So as a point of fact, number one, the ETFs on the gold side have been drained rather substantially. Secondly, the amount of gold that's physically located in the COMEX at this point in time is such a pitifully small amount that a very average-sized hedge fund could take delivery of the entire amount. And I'll have to go on from there, Michael, because everyone will say, why don't they do it? And believe me, there's probably no one else as actively wanting that to happen than myself. However, you have to think it through. If you were to be that entity that took or stood for delivery for that last pitifully small amount of gold on the COMEX, what would come at you? There'd be a lot of going on, even in the mainstream press, of why did you do it? You're trying to take down the market. You're disrupting things. There'd be so much naming, shaming, and blaming that goes on in this politically correct environment. It would be like the most unpolitically correct thing you could do, even though it could be done quite easily. So people that think it through probably do not want to have that kind of negative publicity. However, it could happen anyway, especially if it was a foreign entity, as an example. So further on the gold side, you have massive amounts of physical that is being accumulated in China, India, Asia, really. And so what we have is this point, this tipping point, the singularity, where the physical market and the paper markets will have to converge at one point, at some point in time, and I think it's fairly close. You will see where the paper paradigm will not cover the amount of physical demand. Now, going a step further, most of the gold that's delivered is obviously not off the COMEX. They don't have any for all practical purposes. And it's peer-to-peer, meaning that you have like the smelter refining community that does deals through the bullion banking system, which takes delivery in the over-the-counter market. So in other words, this type of gold delivery that you hear about constantly isn't like the kind of retail dealership or even some of the wholesale dealerships that most people are familiar with that listen to your show, Michael. This is actually a step beyond that, which is where the raw concentrate comes in, smelted, refined, and then it goes direct to these, let's say, big bullion banks where they make these deals. So it's sort of, it's more than a two-tiered market, but we'll call it two-tiered markets. The market that you see that sets the price, which is basically a fiction largely, and then there's the retail market that keeps squeezing down the differential between what really physically exists in reality and the paper markets that can create an infinite amount of it. On the silver side, everything I said to gold applies as much, if not stronger, because on the silver side, there's the Silver Users Association, which is a band of good old boys that have an edict to, amongst themselves, make sure that most of the silver flows through the system I just described. And on top of that, the little guy, or we the people, as we like to refer to it here in the States, have been buying hand over fist since the financial crisis of 2008. And I want to emphasize the point, Michael, that since the financial crisis of 2008, the demand for silver has gone through the roof. And the reason being is a lot of little people, or we the people, get it. And what we get is it is a safe haven. So as much as the negative mainstream media portrays these as non-events and who cares about gold and silver, the truth of the matter is the physical markets are both robust, and it's only the paper paradigm that keeps people in this negative psychology, and that's the main point I want to make. The psychology shifted from positive to negative when silver dropped below 26 and gold dropped below 1550, and it's maintained that negative psychology ever since.
When we look at the actual, mining companies themselves, obviously I think it would make a phenomenal difference which jurisdiction they're operating in. I mean, I was looking at the gold price in Canadian dollars this week is up, as an example. Why? Because the Canadian dollar fell, rather sharply against the U.S. dollar. In Mexico, you'd have the same experience, especially when you look at countries like Brazil, like Venezuela. I mean, you have to take that local currency into account. And I got a feeling, I don't want to be a U.S. producing kind of company, but it must be different when you go to other parts of the world because their currencies have fallen almost as dramatically as gold against the U.S. dollar.
Absolutely true. And, I think you've said it well, but what I'd like to add on to that is depending on the structure of the mining company, or we could apply this to companies in general, if you have borrowed in U.S. dollars and your local currency is depreciating, you've got a real problem, and here's why. Because you are actually paying in a currency that is depreciating, but you borrowed in a stronger currency, which makes it much more difficult to pay back that loan. And unfortunately, the way the system is set up, and I believe this is totally deliberate, is most producing mining companies have to go into some type of debt financing, which requires the bank to be in charge because he who loans the money makes the rules. And so some of these countries certainly have a higher gold price in their currencies, backed, well taken. But if you look further into the mining sector, which we're discussing, then it can be problematic.
That's an excellent point, though, because we talk an awful lot about the amount of, not necessarily related specifically to gold companies, but the amount of emerging market debt out there, I think, is a real problem for exactly as you described, David, which is, you've got their local currencies plummeting and they got to repay in U.S. dollars. So that's another kind of check mark that you'd have to examine very closely before making an investment. Despite, as I say, in local currency, the gold price itself may be up, but if they borrowed in U.S. dollars, that would be very problematic at this point. So tell me your quick assessment of and you can divide it gold and silver or one or the other, but of the sort of mining side of that.
Well, Michael, I'm going to digress slightly on this, and I think you'll be pleased with what I have to say. This is something that we've been working on for over 2 years, and this is something that I think could be the catalyst. I mean, all of us that are in this sector are looking for some type of catalyst that can, make us happy again. In other words, give us some hope or some drive. And this has to do with the mining side, and it has to do with the junior mining sector only, which, for the record, I don't specialize in, but certainly I spend a lot of time there. And when we speculate, we recommend money you can afford to lose, and that's why we call it a speculation. But on this 2-year study that we've done, we have a situation, and I'm going to digress to go back in the history of silver. If you look back in the early 80s, and of course I've been through 2 bull markets due to my age and interest in the topic, there was Jerome Smith was a silver guru in those days, and he talked about, in the mid-90s we're going to run out of silver. And you know what? It took me a long time to figure out what his fatal error was. And his fatal error was that at the time, you could not produce more than 385 million ounces of silver annually. That was absolutely the correct data, and that was for decade after decade after decade. So if you made that assumption, which was valid when he made it, you could project out, okay, you mine 385 million, we're using this much per year, and there's that singularity point I talked about at the beginning of the show. Something's got to give at some point in time. I'm calling it the mid-90s, and he was actually conservative, and he was projecting like $200 silver. What happened? About the time the ink dried on the last book, what happened was there was a huge shift in the way that the mining industry was able to get gold and silver from the deposits. And this caused a huge increase in the amount of productivity of the mining industry, and therefore the 385 million ounce per year mining was absolutely blown away. It just kept going 400, 500, 600. Now we're at almost 800 million ounces of silver per year. So he made that mistake. So when I discovered it and talked about it at one of the shows that Nina puts on, the World Outlook Conference, and the moderator gave me kudos because no one could answer that question. Been asked it for about 10 years. I went on. So now we're in a situation that we have discovered where small deposits, this is the junior mining industry only, can gravity feed gold. And they can do it right on site. So what does this mean? It means a lot of things. Number one, if you're listening to the show and you have a junior mining company and you know that they have a gold value of, let's say, 3 grams or higher that gravity feeds, you want to get a hold of me, and I'll give you that information at the end of the show. But this is something that will allow to progress the company without dilution. Why? Well, if you've got gravity feed gold on project, we can pull up this system and actually get the gold right there in your hands in a matter of a few weeks, actually. And then you can use that, sell it into the market, and self-finance. And this, again, isn't going to change Anglo American that laid off thousands in the mining industry. It was reported this week. This is for these small opportunities that are really stuck in the mud because they can't finance. If you have gold that gravity feeds, you definitely want to know about this new technology. Is it going to be disruptive to the industry? Probably not. But in the junior space, it certainly will or could be something that could be a bit of a paradigm shift. Certainly gives me a lot of hope. And I know there's a lot of really great people out there that are suffering because of the current conditions in our industry.
Fascinating stuff with David Morgan. I want to tell you again, you go to him at www.silver-investor, silver-investor.com. Of course, author, editor of the Morgan Report. I got to take a break. I'll come back more with David Morgan, more on silver, more on gold, right here across the Chorus Radio Network. Canadian dollar, oil up with Victor Adair live from the trading desk coming up. Aussie Jurek, brand new mortgage rules in Canada. We'll get to that. And a Goofy Award. This could have been my shocking stat. David Morgan from www.silver-investor.com was telling us a record amount of paper gold, meaning you might be in the futures market with a claim on gold. You might be an exchange-traded fund with a claim on gold. Well, this could have been my shocking stat, just looking at a report from COMEX over the break here. 293 ounces of gold claims per ounce of actually deliverable gold, if that made any sense at that point. So 293 ounces of paper gold out there, but you want to claim it, you want to redeem it, you want delivery of it from the futures market. Well, there's 293 ounces in paper for every 1 ounce of gold. That's the dynamic that David Morgan was talking about there just before the break. He joins me on the line. David, let's talk about then how to play this market at this point. I mean, investors have had to have an inordinate amount of pressure, patience. But do you see us, and I know, and just tell me if it's just one of those things one can't do, but does it look like near a bottom to you?
It does. You know, I must admit to everyone, and I do this on almost every show, and people tell me don't, but it's me. I've been much better calling the tops than the bottoms. I really think the bottom is in or close enough if you're a professional or even have a professional attitude. If you're an amateur and you think you can buy the exact bottom, go ahead. It's certainly in the buying zone. You should be accumulating like professionals. If you could buy silver under the cost of production for most of the major producing companies, and gold in the same situation, obviously take a deep breath and think it through. You should be purchasing at these levels. I think I'll be consistent here that you should buy the physical metal first. Once that's accomplished, then certainly there's nothing more undervalued than almost every mining company that's worth its salt across the board. There are some in the junior space that are selling under cash, so you get the property or project for free. I mean, these are ridiculous valuations, and anyone that understands value understands what I just said. I came back from the Silver Summit in San Francisco just a few weeks ago, around the Thanksgiving holiday here in the States, and the overall temperament was muted, And there were people that were certainly pulling out money for special situations, but most people were kind of sitting on their hands. And again, I think we're looking for some type of catalyst. There needs to be some energy put back into this market. And I do believe that it will happen in 2016. But referencing back to the San Francisco show, many of my colleagues, peers, et cetera, were stating they thought that we have another year in the doldrums or at these low prices. I disagree. I'll go on record. My track record hasn't been the best on these bottoms, but certainly it looks like a triple bottom in silver. It looks like gold could go down below the $1,000 level as a quick test. What we've seen in the last 4 years or so is that the lowest price print per year is on the last trading day of the year. How does that happen? Quite easily. These paper markets are very, very leveraged. Most of the traders take long vacations, they leave the exchange, and they don't trade at all. So there's very low volume. It's easy to move a market on very low volume, so those that are in there certainly can make some sales that have more impact because the market's what's called very thin. Do I expect that to take place again this year? Yes, I do. However, I want to cover myself slightly because, as you said, Michael, at the very beginning of the show, the fundamentals for owning gold and silver and the underlying equities is so strong right now. Maybe that countervailing force will have some effect by the end of the year. I don't know for sure.
Interesting point you're making, though, that where the buy zone starts is when you can't buy, or rather the companies can't produce the metal at the same price you can buy it at. And obviously that will dry up supply. There won't be producing more if they can't do it at any kind of a break even, let alone a profit. And that will shrink supply, or at least put a cap on it. And then, of course, any increased demand, whether it's someone just literally taking delivery from a futures contract, et cetera, can put upward pressure. It's an interesting criteria that I think people should think about.
Thank you for that. I'd like to add on a little bit about the industry at large. There are, as most have studied it,
We've only got about 1 minute left, David. I'll just let you know. Sorry.
Okay. Well, let me do this. I want everyone to get the free report on the special technology. So you need to go to themorganreport.com. That's another domain, www.themorganreport.com/new report. That's themorganreport.com/new report. It's absolutely, totally free. Mike, I'm doing this for you, for your show, for your listeners. Please spread the word. Please forward it to friends. themorganreport.com/new report. We will send it to you. It's going to take me about a week to put it together, but I want everyone to know about this new technology. And what I was going to say is that many gold mines mine at 1 gram per ton. E-waste, smartphones in a dumpster are 3 grams per ton. Think about that.
Yeah.
These mining companies are going to be struggling.
Interesting stuff, as always, with David Morgan, themorganreport.com, and get a hold of that new report, because that sounds like absolutely fascinating stuff. David Morgan, silver-investor.com.